Welcome back. Hopefully you've already watched the Chapter 1 video for learning Objective 1. So we're going to pick up with learning Objective 2 and talk about the organizations and the rules that govern accounting. So here in the United States, we have two primary organizations that oversee accounting. We have the Financial Accounting Standards Board. They're a private organization that creates the accounting standards or the rules, if you will. The key word here is that they are a private organization, meaning they're not a governmental agency, which means they have no legal authority. They have no legal jurisdiction to enforce the rules. They just make them. Then we have the Securities and Exchange Commission, or the SEC. The SEC is a governmental agency that oversees the U.S. financial markets, which means they have legal jurisdiction over the companies whose stock is traded on one of our national stock exchanges, the New York Stock Exchange or the NASDAQ. So if you are a corporation and your stock is traded on the New York Stock Exchange or the NASDAQ, then by law you fall under SEC jurisdiction, which means you have to follow the SEC rules. Now the SEC doesn't actually make any accounting rules. What the SEC says is you have to follow the rules that the FASB makes. So the FASB makes the rules, but they have no power to enforce them. The SEC enforces the rules, but they don't make them. There's only been one time that the FASB has passed what we call a pronouncement, that basically a new accounting rule that the SEC said, yeah, you don't actually have to follow that one, and the FASB quickly rescinded it. So I need you to know, anything the FASB says, the SEC basically says, yeah, you have to do that. That is, again, if your stock is traded on one of those national stock exchanges. So what if you're a small company? You're not publicly traded. Do you have to follow SEC rules? Well, in a legal sense, no, you don't. Now, you do have to follow IRS rules and tax rules, but IRS rules are separate anyway. The IRS doesn't really have anything to do with what we're talking about here. Everybody has to follow IRS rules, and we're not going to get into those in this class very much. So if you're a small business, you're a sole proprietorship, you're a partnership, you're not legally obligated to follow SEC rules. You don't have to follow the FASB's rules. You can use that cash basis accounting that we talked briefly about in Objective 1, or you could, follow kind of some mix. But if you are a publicly traded corporation, even if you're not a publicly traded corporation, but you are a sufficiently large corporation, and I believe, if last time I looked it up, meaning you had 250 million or more in assets, such as Mary Kay as an example. They are a corporation, they are very large, but they are private, meaning their stock is not available for sale on the NASDAQ or the New York Stock Exchange. Then they still have to follow SEC SEC rules, even though they're not publicly traded. So this class is specifically focusing on accounting for those large corporations. We're not getting into small business, sole proprietorship, partnership, kind of that sort of accounting. We have a different class if that's something that you're interested in, but that's not really what this class is. This class is focusing on that large corporate accounting. So the FASB passes these rules, and those rules are called GAAP, or Generally Accepted Accounting Principles. Now, don't let this title fool you. I know generally accepted makes it sound like it's a suggestion, right? But don't let that fool you. If it's part of GAAP, if the FASB has issued it as a pronouncement and you are subject to SEC jurisdiction, then you have to follow it. You can't come back and say, yeah, I decided not to. I thought that was just a suggestion. Now, GAAP gives us lots of options and lots of leeway, so we do have some flexibility to use our judgment in there, but we're still obligated to follow GAAP. So let's go back a minute and talk about some of those smaller companies who maybe don't have to follow GAAP legally. They're not subject to SEC jurisdiction. Here's the thing. If you're ever going to have to go to a bank and get a loan, or you're ever going to seek new investment, you're going to have to provide financial statements. And those financial statements are expected to be prepared according to GAAP. So you can't walk into the bank and say, I'd like a loan for my business, and here's the financial statements I've prepared using the Simpson method of accounting. That's not going to fly. So really, you need to be following GAAP even if you're not legally required to. Now, GAAP is based on two primary principles. Number one, it has to be relevant. And when we say information should be relevant, it means that it would make a difference to you if you were a decision maker, right? So if you're going, wow, if I really needed to know this, if I had known this, I would have made a different decision, then it's relevant. It also has to be what we call faithfully representative, which that means, number one, it needs to be complete. We don't want to have conveniently left out some information that would have been relevant. It needs to be free from error, right? We hope that 2 plus 2 is 4. We didn't put the wrong numbers down. It also needs to be neutral. So let's go back to this neutrality. Remember, under financial accounting, we are providing information to those external users, people outside of the corporation. And we talked about in Learning Objective 1 that that includes the investors, the owners. So in a corporation, the investors, the owners are external. I own some companies. I own Disney. I'm not making this up. I legit own Disney. We'll talk about this a little bit more in a minute. But as an owner of Disney, the only information I get about the company I own is from these financial accountants that work for Disney. So remember, they're applying their accounting judgment. They're making estimates because a whole bunch of these accounting numbers are all sorts of gray and fuzzy. And when they are applying their accounting judgment, their professional judgment, I need them as the owner to be neutral. I need them to not let their personal opinion sway them, right? Because it can. If I really, really love my job and I want to make estimates that are optimistic, or I really, really hate my job and I hate my boss and I think he's the spawn of Satan, and I want to make estimates that are really, really pessimistic. As a financial accountant, we have to try to remove our bias out of that and make the estimate that is neutral. We have that duty to our users, to our owners, to our creditors. Now, in a global scale, most of the rest of the world, over 166 other countries or nations, use what's called IFRS, or International Financial Reporting Standards. They are published by the International Accounting Standards Board, or the IASB. The U.S. has not chosen to adopt IFRS yet. The FASB is looking into it, and they've said that they would make a decision by June of 2014. We're still waiting. My opinion, this is purely my opinion. I promise to always tell you when I'm espousing my opinion, but this is my opinion, is that it's not so much if we're going to adopt IFRS, it's how. So there are a lot of similarities between US GAAP and IFRS, but there are some fairly significant differences. And moving from one accounting system to another is not like upgrading the operating system on your computer, where you press some buttons, it shuts down, it restarts, it shuts down, it restarts, and it comes up and it all looks different, but all your data's still there. Doesn't work that way. In order for us to go from US GAAP to IFRS, companies would have to dramatically change how they account for certain items, and we'll talk about some of these as we go throughout the semester. And those would create either some gigantic gains or some gigantic losses. In my opinion, again, purely my opinion, is that our financial markets have not been really stable enough since in the past 10 years or so that they've been willing to risk it, that might just be the thing that pushes us over the edge. Again, that's purely my opinion. So again, there's a lot of areas where we're similar, but then there's some fairly significant differences. Now, we're going to talk about an audit a whole lot more when we get to Chapter 7, but one of the SEC regulations is that if your stock is publicly traded on the NASDAQ or the New York Stock Exchange, you have to have an audit, which means you have to hire an audit firm to come in and basically review your entire accounting system and make sure that you're following all of the rules correctly. And these accountings that come in and do this, they're called auditors. They're experts in accounting, and they come in and they go through your entire system and they're like, yep, you're doing a good job. Your system's set up correctly. You're following all the rules. Or they're like, you seem to be doing a great job except for, or you're not doing a good job at all. Again, we're going to talk about this a whole lot more in Chapter 7, so I'm just kind of laying the groundwork, introducing the topic now. What we're also going to talk about more is what's called the Sarbanes-Oxley Act, which came out in 2002. It was a direct result of the Enron scandal, and there were several other accounting scandals that happened right about that same time. WorldCom, Tyco, Waste Management, all of them kind of happened at the same time, but Enron was certainly the biggest. And one Sarbanes-Oxley, or SOX, did lots of things. We'll talk about it more in Chapter 7, but one of the things that it requires companies to do is to review their internal controls, those internal systems that they've set up to make sure that everyone's following the rules, to try to help prevent misstatement, that sort of thing. So this is a really big deal that we'll come back and revisit in a few chapters. Now, there's some assumptions that GAAP is based on that we need to kind of briefly talk about before we can move in. These certainly aren't all of them. These are just kind of the intro. First of all is the economic entity assumption, and this assumes that the business, the organization, is itself a separate economic entity from its owners. So as an economic entity, you can be a sole proprietorship, a partnership, a corporation, an LLC, there's LLPs, there's other things like that. But the business is separate and distinct, kept separate and distinct from its owners. So in this class, since we're going to be talking about corporations and corporate accounting, we're going to first spend a few minutes talking about some of the features of a corporation. One of the things that makes a corporation distinct and different from other forms of business is that it is legally a separate legal entity. Okay, not just we're treating it as such, but it is legally its own person. A corporation has rights and privileges under the law, just like you and I as individuals do. They can't vote in public office, they can't hold a driver's license, but other than that, they have just about all of the same rights and privileges that a person does. Now, if you contrast that with a sole proprietorship or a partnership, even though you may keep the business separate from your personal finances, you never commingle funds, you keep everything separate. In a legal sense, the business is not separate from the owner. In a legal sense, if you think about a tax return, if you own a small business, you file your personal 1040, and then attached to the back of that 1040, you attach a Schedule C, which shows your business's profit or loss. If you're a partner in a partnership, the partnership does not file its own tax return. You as the partner will file your personal 1040, and then you'll attach a Schedule K that shows your share of the partnership's profit or loss. And that taxable income is rolled into your personal taxes on your 1040. But as a corporation, they file their own tax returns, separate and distinct from their owners. I told you earlier that I own Disney. It's true, I am an owner of Disney. I own stock in Disney. Anytime you own stock in a company, you are an owner. So a stockholder or a shareholder, an owner, those three terms are all used synonymously. So as a stockholder, I own Disney stock. That means I'm an owner of that company. I like to say that makes me legally a princess. However, I don't get to see Disney stock return. They file that on their own. Tax return. They file that on their own. Then I file my personal 1040. Now, if Disney paid me dividends, which we'll talk about in a little bit also, then I do have to report those as income on my personal 1040, but I don't I don't file a portion of Disney's tax return on my personal 1040. So a corporation is its own legal entity. It has continuous life and transferability of ownership, which means that when ownership changes, the business doesn't end. So if I were to be a partner in a partnership or own a sole proprietorship, and I were to sell the business or sell my share of the business in a partnership, legally that business ended and a new business began. But a corporation keeps running independent of its owners. No mutual agency just means that I can't go to the bank and take out a loan on behalf of Disney, even though I'm an owner. Limited liability, this is a huge one. You want to star, highlight, triple underline this one in your notes. Limited liability says, as a stockholder, the only amount that I can lose is what I invested with them. Creditors, if Disney were to go under tomorrow and file bankruptcy and all their creditors were suing for their money, they could not come after me as an owner. Now, if I were a partner in a partnership, and let's say that my partner did something really, really bad and got the business sued, legally, and there are things that I'm not a lawyer, so there are things that you can do to protect yourself, and if you're in business, you should certainly consult a lawyer to do this, but the creditors could come after me. They could come after my house, after my retirement, after my savings, after my kids' college funds. They could come after me personally. But as a stockholder, my liability is limited. I can't lose more than I freely invested. There is this big separation of ownership and management. So we've talked about this a little bit. Again, as an owner of Disney, as an investor, as a stockholder, as a shareholder, I am an outsider. I don't get to walk up to Disney and be like, let me in, I own this joint. Okay, I do own it, or a part of it, admittedly small part, but I own a part of it. But I don't get inside information. I don't even get discounted tickets to Disney, y'all. But I don't get to walk in there and be like, this is my company, I want to know. I'm an outsider. The only information I get is what those financial accountants give me. Now, I do get, as an owner, to vote on a board of directors, and we'll talk about this a lot more in Chapter 13. And the board of directors represent the stockholders' interest directly to the company, sort of like how we elect senators and representatives to represent our interest in government. There's a lot more government regulation if you're a corporation than if you're sole proprietorship or a partnership. And then we've talked about corporate taxation a lot. Remember, the corporation will file its own tax return. We'll come back and visit a lot of these topics when we get to Chapter 13 as well. Now, a couple of other principles that I need you to know. The first one is the cost principle. This one's huge. You want to highlight, star, double underline this one in your notes. You'll oftentimes hear this one called the historical cost principle. This says that assets, now an asset is anything that we own. We'll define these later, but an asset's anything that we own. Assets are recorded at their actual cost. And another way to think of that is their historical cost, meaning what we paid for them when we bought them. So let's say that my company owns a car, and I bought that car 5 years ago and I paid $30,000 for it. So when I look at my financial records, that asset that I own is going to be listed on my books at $30,000 because that's what its actual cost, which historical cost is. That doesn't mean that it's worth $30,000 today. I know it's not. It's a 5-year-old car. It's worth way less than $30,000. But as long as I own it, it will be listed on my books at $30,000. The U.S. does not use fair value accounting except in some very, very, very rare circumstances that we're not even going to get into this semester. So they use historical cost accounting, which means when you look at a company's balance sheet and you see all of their assets listed, everything that the company owns, it's listed at what they paid for it. So if I were to look at Disney's financial statements and I see land is listed at, I'm making up a number, I don't have Disney's financial statements in front of me at the moment, but land's listed at, let's say, $2 million. That's not what that land's worth now. That's what that land was worth back in 1940s when Walt Disney bought it, and it was nothing but an orange orchard in the middle of California. It's not what it's worth now. It's what it was worth back then. So the going concern assumption just says that we're continuing in business. We're not, for the foreseeable future, we're not planning on closing down. We're not planning on filing bankruptcy. If we are planning on, like, let's say the auditors come in and we're like, look, we're headed to bankruptcy. Recently, Pier 1 filed for bankruptcy. So in their last audit, they were no longer listed as a going concern. Then the rules of GAAP change. But we're assuming we're continuing in business indefinitely. The monetary unit assumption just says that anything that we list on the financial statements will be measured in terms of a monetary unit. For us, that would be a US dollar. Now, I realize that may seem like a duh statement, but we're going to find, not so much in this class, but especially in the next class, that not everything is initially listed in a dollar amount. Sometimes we have to estimate what that dollar amount's going to be. And if we're an international company and we're conducting transaction in a foreign currency, then we have to translate that back to a US dollar. And then there's lots of rules of, well, what rate do you use to translate it? The rate at the translation rate at the airport or the rate at the bank? What day do you use? Because those change. Now, again, these are things that we're not going to get into a lot in this class, but I just want you to kind of be thinking about some of these concepts.